Let's compare and contrast two gimmicks in personal finance, the Backdoor Roth IRA and tax loss harvesting. Hi, this is financial planner Sean Mullaney. Let's discuss. So there are two concepts that personal finance content creators, financial planners, pundits, commentators talk about a lot. One is tax loss harvesting, and often that has a flavor of sort of artificially creating a loss, navigating the wash sale rules. So maybe we take mutual fund A and then sell it, trigger a loss, put in mutual fund B, and mutual fund B happens to look 85% like mutual fund A, but good enough, right? Generally speaking, not giving you advice. And the Backdoor Roth IRA, right? People love to talk about these two concepts, and I will say they are gimmicks, 100%. They are gimmicks, and I think that does inform whether we should do them or not, but there are other considerations. Let's think about a Backdoor Roth IRA for a second. That's a synthetic way to get money into a Roth account when our income's too high to make a regular annual contribution. But what does a Backdoor Roth IRA accomplish and what doesn't it? And how often and how sustainable is it? Well, the Backdoor Roth IRA, let's just assume you're under 50, $7,000 into a Roth account in 1 year. That's good, but certainly not life-changing if we're thinking about a lifetime of personal finance. But what if you did that transaction 10 years in a row, 15 years in a row, 20 years in a row, even 5 years in a row? What have you done? Well, you've gotten the growth on possibly 6 figures or more. It's not going to be 7 figures, of course, but a 6-figure number potentially outside of federal and state income taxation. That's a real good, right? That's a real benefit. And you haven't had to adjust your investment allocation one bit. It's just another investment. You always, generally speaking, during the accumulation phase, we're adding to our investments all the time, generally speaking. So that's not an issue. There's no change in investment allocation to manage for. And we've gotten that money into a creditor-protected vehicle. And look, umbrella insurance can help as well, but why not belt and suspenders it? It never hurt to have more creditor protection. Roth IRAs have federal bankruptcy protection to a degree. Roth IRAs have varying levels of state creditor protection. Why not do that? The other thing is it's sustainable. We can repeat the Backdoor Roth every year, year in, year out. Very sustainable. So yes, the Roth IRA is a gimmick, but it doesn't alter our investment allocation one bit. It gives us real tax benefits. And by the way, who knows where taxes are going in the future, right? I tend to think retirees will be lightly taxed in the future, but that's not a guarantee, of course. Of course not. Why not have some insurance, especially if we don't have to pay additional tax for it? And we're getting some more creditor protection with that Backdoor Roth IRA. That's a gimmick that I, in a general sense, think is well worth it, particularly if we're going to do it over several years' time. Okay, but it is still a gimmick, to be fair. All right. Well, what about tax loss harvesting where, if we're doing tax loss harvesting because we're in mutual fund A and we really want to be in mutual fund B and mutual fund B is totally different from mutual fund A, great, do it, right? We're improving our investment picture. We're improving our tax picture by triggering a loss. I love that. But you see this flavor of, I'm in mutual fund DEF. And it owns 5,000 stocks, and I don't really, I'm fine being in DEF. That's my preferred investment vehicle, but I got a little bit of a loss in there. So couldn't I sell that and immediately rebuy, GHI, which has 3,500 shares, and they're 80 to 85% correlated. So I'm not really changing my investment picture, but I'm navigating this wash sale rule. There's a substantially identical issue to navigate, and I can't give you tax advice on that issue, but generally speaking, substantially identical means pretty dang close, and a different index is probably going to be good enough. You got to do your own assessment. I'm not giving you advice on the channel on that, but what are we doing with tax loss harvesting? Well, one, we are at least slightly changing our investment allocation. Now, yes, that could be a very modest change. Second thing we're doing is we are getting a one-time tax benefit, and that's nice. But boy, if we don't have any other losses, that one-time tax benefit is limited to $3,000 of a deduction this year. You got to tax affect that. So it's not a $3,000 benefit this year. It's a $3,000 tax deduction. And oh, by the way, all right, maybe we carry forward some of that to future years. So it could be a little bit more than a one-time tax benefit. That's a gimmick that doesn't seem to be giving us benefits beyond a one-time or one-time plus tax play. And look, neither of these gimmicks are your key to financial independence. But if I'm going to pick between the two gimmicks, I'm going to pick the one that's more sustainable, that doesn't in any way alter our investment allocation, that gives us more creditor protection, a huge, that's a nice little feature of the backdoor Roth that tax loss harvesting doesn't touch. So look, does it make sense on occasion to deploy tax loss harvesting? Sure, it can, but it's a bit of a gimmick, and I've yet to meet the person who got to financial independence or early retirement or whatever you want to call financial success because they deployed tax loss harvesting. And I'm not here to say I've met the person who did it, who got to financial independence because of the backdoor Roth. But the backdoor Roth seems to have a lot more substance and to my mind can do more over more periods of years to really get us to financial independence. And not that anybody's going to just say, oh, I did 20 years of a backdoor Roth IRA. That's enough to retire on. But now you get to maybe it's an early retirement or a later retirement. You got all this Roth money you can deploy, maybe selectively withdraw, increase premium tax credits. That seems to me like a gimmick that's a lot more worth pursuing than the tax loss harvesting gimmick. But let me know what you think in the comments below, right? Do you love tax loss harvesting? Do you love the backdoor Roth? Let me know in the comments below. Thanks so much for watching this video. If you enjoyed it, please mash that like button and subscribe to my channel. I'll see you next time.